We are back with Philip Manduca talking about the implications of the euro and dollar movement, and of course the euro, Philip, benefiting as the dollar moves lower today. Is that more symptomatic of the weakness in the dollar, or have things alleviated in terms of fiscal issues in the eurozone?
It's a bit of both. The euro is always the reciprocal of the dollar, and the dollar is the major driver here. It has the most macro fundamental volatility. So what happens to the dollar, the reverse happens to the euro. But there has been a covering up of the cracks that remain in the European Union. And those cracks, I was investigating them even, for example, in Greece last week. Those cracks are going to resurface in 2011, Murray. You can count on that, because at the heart of the problem lies fiscal disunity in a monetary union. And you're not going to get over that. And the problem in 2011 is going to surface because they're just not going to generate either the growth they need to get the tax revenues, which no one's going to want to pay in an environment of public strife and dissent at the cuts that are going to come.
Do you think that's priced into the market, or do you think this is going to be a surprise when these issues come up again?
Well, when they do come up again, and they're going to, I suspect, sometime towards the end of the first quarter into the second quarter next year, I don't think it's priced. I think what's being priced at the moment is money push, money supply, QE, whatever you want to call it, which, of course, is not dealing with the problem. The problem is not money supply, Maria. It's money velocity. Yeah. Get the money pushing around. It's not the quantity of it. There's loads of money out there. So I do think once that sort of situation and phase goes through and the economics continues to be benign and the dollar settles down, we're going to go back to a situation where in Europe the growth just isn't going to be strong enough to generate the kind of tax revenues that's going to hold the numbers together. The numbers don't add up in Europe, and no matter what's happening to the dollar today, we mustn't forget that.
Many of the issues that you're talking about in the eurozone, we're dealing with in the United States as well, obviously. But let me ask you about quantitative easing, because we've been talking about QE here as the Fed stands ready and continues to reiterate that it stands ready if the economy deteriorates further. Will the UK do QE?
Well, it's the debate, and the pound's been punished in the last couple of days after one of the Bank of England members, in fact an American, who's a guest member of it, started saying, well, let's do some more of the American policies. As I say, the problem is not supply, it's velocity. And I do actually think there's a real risk in the pound here that the government doesn't do the fiscal cuts and degree of austerity that is currently being priced. In other words, I think it's a real risk that the government pushes those cuts out to 2012 and 2013. And that, Maria, would push the onus on the Bank of England to deal with a higher inflation. So there's a real risk that actually interest rates could threaten to go higher in the UK, and they don't do QE after this announcement on October 20th. And the risks, therefore, are that the pound is underpriced and cheap at the moment.
So it's even a vicious circle. And you say that the U.S. has really been the major factor causing these world imbalances.
Well, you know, I've got this problem with the U.S. There hasn't been an empire in the history of mankind that's given away its wealth and its power base like the United States is currently trying to do. What are you doing? You've got 20% unemployment. You're trying to bail out the Chinese. You're trying to bail out the Indians. You're trying to bail out the Middle East. And no peace is arising. You've got wars still everywhere. So what are you doing? Why are you allowing this huge transfer of your wealth to these other countries who, I promise you, from an international perspective, are laughing?
Really fascinating. So what's the play then here? How do you see this playing out? And is there an investment then, for example, in the safety of gold or in other areas?
Well, you have to go to gold because, of course, what you've got here is a situation of continued necessary deleveraging, no more so than in the United States with its housing bust. In a situation where more money is having to be pushed at it, even though the velocity remains low, and this debasement is a problem. But the gold story, Maria, you're all focusing, and I've been watching what all you've been doing on CNBC, you're focusing on it as being a Western issue. It's not. It's an emerging market driver. What you've got in the emerging market countries is too high inflation going higher, interest rates that aren't dealing with that because they don't want to push the interest rates up to get stronger currencies because they're all export driven. And so you're going to get what we had actually in the 1970s in the West, a real inflation bubble coming out of Asia and the emerging economies. And it's those guys that will go and buy gold just as we did in the 70s. They'll be buying gold. And that's why, more than debasement, and although debasement is a factor in the West, more than that, though, you've got the inflation coming out of the emerging markets, which will push gold through to 2000 in the next 12 months.
Not to mention that the central banks have really legitimized the trade on gold, having bought as much as they have. Very quickly, as far as the complaint on the U.S., what would you like to see the U.S. do?
I'd like to see the U.S. tell people either you play with the right ball with us or we're not playing with you. I know that sounds protectionist, but it's the right way to get rebalancing.
Certainly the story on China, many would agree.